Thank you for tuning in to learn about the role of accounting. Be sure to check out our other videos in this series. By the end of this video, you will understand how accounting functions within the diverse types of organizations and how an organization's financial information is shared with its users. We will explore questions such as what accounting is, why it's needed, the type of decisions that require accounting, who needs access to this information, and how accountability is created within organizations. What is accounting? Accounting is the language we use to communicate in the context of business, commerce, and trade. It helps us maintain records of various business transactions and categorize them appropriately. We use it to produce financial statements so we understand how an organization is performing. By interpreting financial statements, it allows us to make better decisions. Without it, we cannot fully demonstrate to interested parties the financial position and performance of an organization. A concept that has existed and evolved over thousands of years around the world, historically, people used primitive accounting methods to keep track of various transactions. The two most commonly referenced accounting branches are financial and managerial. Financial accounting serves the needs of external users. It is the recording of transactions to produce a formal financial statement. Made for its internal users, managerial accounting is less restricted. Its core activities include providing strategic direction, performance measurement, and the various streams of management of business, costs, processes, and risks. Let's explore the importance of accounting. In the old times, when business transactions took place, accountability existed between individuals. Now, one can operate under a distinct legal entity that is separate from the individual. We call these organizations, which can be classified into three categories. Public organizations include indigenous and non-indigenous nations and governments, crown corporations, health authorities, school districts, and academic institutions. Private organizations include sole proprietors, partnerships, corporations, and co-ops. Nonprofit organizations are typically charities, societies, associations, clubs, and trade unions. All of these provide service and goods to their customers and clients in exchange for money. To do that, they acquire services and goods from their suppliers and service providers. This inflow and outflow of money has to be reconciled, and accounting makes this process possible. Let's look at it from a different angle. An organization is typically financed through equity by its owner or through lending by a bank. Both are financing the staff, operations, and infrastructure that leads to the creation of goods and services, which are in turn sold to customers who provide a return to the owner and bank. The owner is legally obligated to report these activities to regulators and tax authorities. They are held accountable by the citizens of their jurisdiction to operate in a transparent and fair manner. This is the cycle in which our modern society operates, and accounting plays a critical role at multiple junctions. So what are the types of organizational decisions that require accounting? Financing decisions involve borrowing money and raising cash. Investing decisions involve acquisition of resources. Operating decisions have to do with how revenues are generated and how expenses are incurred. Accounting helps track these decisions. Managers use this information to make informed strategic and operational adjustments. But they are not the only interested parties. Let's take a closer look at other users. Internal users make decisions about an organization's performance. These could be owners, leaders, officers, managers, and employees. External users include investors, tax authorities, suppliers, customers, and regulators. Most questions from users revolve around three things: how much cash was moved from one year to another, how much wealth was created, and how much wealth has an organization accumulated over a period. The answer to the first question is found within the cash flow statement. If you want to know how much wealth an organization created last year, you will need to look at its income statement. And to understand the accumulated wealth, a balance sheet, also known as a statement of financial position, is what you want. Who is responsible for preparing the financial statements? This is the job of senior leadership and management. Directors, councils, CEOs, and CFOs are often personally required to certify that a financial statement is not misrepresented and captures the organization's financial condition accurately. They are also responsible for implementing and maintaining an internal control system to ensure that the financial information is reliable. This is done by establishing suitable accounting practices and policies and applying them on a consistent basis in accordance with generally accepted accounting principles. Once a financial statement is prepared, independent auditors are often required to verify both the statement and the internal control system. Creating and maintaining accountability is no easy feat. It's a shared responsibility among an organization's key players. The leadership provides strategic guidance, sets values and standards, provides financial and human resources, and monitors management's performance. Leaders are given different names depending on the type of organization. An indigenous government's leadership would include chief and council, whereas a private organization's leadership would include directors. Leaders are the intermediary between beneficiaries such as community members or shareholders and managers. Managers are the implementers of an organization's vision. They are responsible for the day-to-day affairs. This includes implementing the strategy approved by the leadership, maintaining records and information, managing assets of the organization, developing and implementing policies, managing staff performance, and reporting back on overall performance of the organization. Auditors are independent professionals who verify leadership and managers' efforts by providing assessments based on accounting and auditing standards. Auditors examine financial records, detect material misrepresentations, and evaluate internal controls. They are elected by the ultimate beneficiaries and are required to report back. We hope this video has been helpful in demonstrating the role of accounting. Subscribe to our channel and find us on our socials for future tutorials. See you next time.